So it's not just the numbers are important, we need the financials, that's the groundwork, but then we need to understand the story and the growth path of that business. Is it quite steady, makes the same profit every year? Again, these things affect the multiple. So hi everyone, so today we're just doing a quick 10-15 minute video session on the topic today is about business valuations, just talking all things business valuations really, for people that do know, for people that don't know. So for anyone that doesn't know, I'm the Corporate Finance Director at Gravitate.
And I'm Jonathan, one of the other directors at Gravitate.
Brilliant. So yeah, it's going to be talking about business valuations, why they're important, maybe sharing a couple of experiences as well, just a general chat. So nothing too formal, just having a chat. So I think you're going to be asking me questions.
I'll ask the questions. I'll just chip in with colourful anecdotes. So I think that's the best place to start is what, obviously valuations, people talk about it all the time, but what is a business valuation?
Yeah, so basically, if you're a business owner, you've got shares in the business. Those shares are worth something, generally speaking. So it's no different than owning a house, and having property that's got a value, intrinsic value. So there's no different with a business. So that's that's why they're important. Why they're important. So really, business valuations are important. Lots of different reasons. If you come in to sell, for example, you might want to know what's it worth. It might not be the right time if it's not meeting your expectations. Then having a business valuation early doors helps in that decision process.
And that's the key thing as well, is that expectation, because obviously a lot of business owners will have run a business could be running for 10, 15, 20 years, and they'll have a certain idea of what it's worth to them, but that'll be a very passionate kind of feeling, whereas the valuations and obviously the different methods of valuation, that kind of puts like a market spin on it. Obviously there's different ways to value, isn't there? But this kind of brings it back in line with the you're here, they're there, and the market's here sort of situation. So that's quite key to get across.
I think a good point you made there is about business owners being passionate about the business. Often what you tend to find, generally speaking in the SME space, is they overinflate the valuation. They think it's worth more than what it is. Which is fine, let's shoot for the stars. And if you get, particularly if you're coming through sell and you've got a strategic buyer, then you try and maximise value, and there's ways of sort of putting yourself in that position to maximise it as much as possible. But generally speaking, it's much better to get an advisor to tell you roughly what he thinks it's worth. Maybe that includes benchmarking against similar companies in the sector. Maybe that's businesses that, in my experience, I've been involved with, so I sort of know roughly what businesses are going to be sort of worth in the sector that they operate in. It just sets that right expectation level. It takes that passion out and just gives them facts as well about what's more realistic. So,
and is that where the independence comes in? Because obviously an independent valuation is for certain items. So is that?
Yeah, so independent valuation, it depends, I suppose really it depends what context, but in an independent valuation review, often it's, we're asked to do an independent review where maybe another accountant has already done a valuation, or another business advisor has done a valuation, and that needs sense checking, double checking. So a typical example would be EOT transactions. So if you're a business owner and you sell to an employee ownership trust, often that's the valuation piece is done by an advisor. And part of the process, it was recommended that an independent review is done of that valuation. So it's just making sure that the valuation because in its essence it's a theoretical valuation. It's making sure that that's robust and defensible more than anything. Because an independent review comes more in where people like HMRC are going to may look at it, other stakeholders are going to take an opinion and view the valuation on the work that's done. So that's where independent valuations come in quite key, I think, in those sorts of situations.
And so what are obviously we mentioned that obviously there's valuations, a few different methods of valuation. Obviously there'll be what you put on paper and then what people have got in their heads, and obviously evaluation to future income and evaluation of contracts that are coming up and stuff like that. But what are the key main sides of valuation?
So I mean, for most, and again, talking about, there's lots of different types of valuation, but the key ones really for most SME business owners are, generally speaking, an asset-based valuation or an earnings-based valuation. So an assets-based valuation is looking at your net assets of your business, so looking at your business assets, your balance sheet, but not just your assets like minus your liabilities. you might have a lot of properties in there that have been written off over time, and the market value of those properties are worth a lot more than what the book value is on the balance sheet. So it's generally an asset-based valuation with an uplift for market value of certain assets. So that tends to be for businesses where maybe it's low profit, but you've got a lot of assets.
Yeah, it's an asset rich, so someone that's got a lot of plant and machinery, a lot of property, a lot of stuff that has still a bit of fair intrinsic value, or if you're buying them because they have access to that machinery or that special project or that special patent and stuff like that.
Tends to be more, like say, businesses where the lower profit margin tends to be businesses with property in it as well. So they're the types of businesses that see asset value. Earnings based is looking at profitability. So what does the company make from a profitability point of view, and applying a multiple. So generally speaking, you can get earnings based valuations, you can get revenue based valuations. So certain sectors rely on revenue based valuations. Obviously the multiples are a lot lower because you're taking a higher number. But again, I would say that most businesses in the SME space, even if you're going to value it on a revenue base, the profit still has to be there. It has to make sense commercially. So they're the two. There's lots of different other methodologies. If you're a startup business, you might want to look down a different path. There's discounted cash flows. If you've got predictable revenue streams going forward, you might want to sense check and do a discounted cash flow. But if we're just talking about the main ones in the SME space, it's asset-based and earnings-based valuations.
And that multiple that you mentioned, that's where your experience comes in, isn't it? You understand the market, you understand what sort of deals are going off in the market for the same industries or similar industries, and that multiple is something that's where your experience comes in, into, as well as market factors.
You're right. So we typically benchmark most of the valuations where we can. If it's a niche business, that's where it comes down to judgment, a lot of judgment. If you've got a really niche business and it's relatively small, it becomes a little bit harder to value it, and that's where experience comes in, and number of valuations. I've done hundreds and hundreds of valuations now, so I feel comfortable with certain sectors.
You know where the market is.
You know where the market is.
You know what the general kind of vibe and feel and multiple is there.
Because whenever you're benchmarking as well, the multiples are going to be uncomparable, so you've got to discount it a lot anyway. But you're right, experience comes into it, number of valuations, you just learn a lot about different sectors and how businesses value just because you're exposed to it a lot more.
And so what is, obviously keeping it basic for now, what is the typical information you need for a valuation? Because obviously people come to us wanting a valuation, but then they're missing the basics, like they're not working with an accountant on a regular basis that gives them accurate profit and loss and turnover and profit figures and that. So what is the very basics that you need to get at least somewhere there?
I think really it's banging the drum again about accurate, up-to-date information. That's quite key. If you wanted an accurate valuation, then the more up-to-date that information is, the more accurate the valuation is going to be, in theory. So P&L, balance sheet, cash flows, they're the sort of things that we start with. But then things like, it's really important when you're doing a valuation, you understand what the business does, who the customers are. Is it highly concentrated? Do they work with one or two customers, or are they well spread? So it's not just the numbers are important. We need the financials, that's the groundwork, but then we need to understand the story and the growth path of that business. Is it quite steady? Makes the same profit every year? Again, these things affect the multiple really in most situations. The profit figure assessment is more driven by the actual financials that you get. So the more accurate they are, the more accurate.
And just like a year end that's 9 to 12 months out of date, that's not going to cut it, is it? You'll be valuing it on historic and very historic data. So you need to be like last month end or last quarter end, don't you? Really, it needs to be up to date.
Ideally, I think if you've got a business that always makes 200 grand a year profit, then there's probably a fair assumption to say, even if it is slightly out of date, it's probably going to make the same. You still have to check it and make sure it is. But I would just say, just keep your figures up to date, because then you're going to get a more accurate valuation and a more defensible valuation if it ever comes to it. So
the more back up there. So obviously they're the basics. So what are the practicalities? So what are the key, obviously we mentioned earlier that sometimes, especially in the SME market, business owners maybe have a higher perception of the value of their business than what it is, which is fine, obviously, like you said, reaching for the stars, they can see the intrinsic value that's over and above the numbers. But
Yeah.
what are the common mistakes that business owners are doing? Because when we talk about valuations as well, it's proving, like I said, that timeline. So having a couple of years of accurate, up-to-date, good-looking data helps valuation, especially if you are looking to sell. But what are those mistakes that people are doing in that time span that's really damaging?
Yeah, I think we touched on it already, like poor record keeping, really, generally speaking. You know, it really is important you keep your records up to date. You know, unexplainable variances. So where trading's maybe dropped or increased, ideally we need to know why that's happened. Is it sustainable? Are we going to see? Because if you've had a bumper year, well, from a valuation point of view, we need to know, is that the level now?
Is that
maintained? Is that maintained?
Yeah.
Is that going to continue? Is it going to drop? So we need to know why things have moved as well. I think reliance on the owner too much as well, that can drive the multiple down in a lot of situations. So is the goodwill with the business, not with the business owner. So again, focusing on the SME space here.
And that's a strong senior team, and to replace that is having a strong senior team that could replace you, even if they're not quite ready there, but could replace you if you were to step away. It's like it's not tied to you as the key thing that's running that.
Yeah, exactly. So that's what's going to drive the multiple. If you've got a second tier talent management team, you're a shareholder that's passively, you know, not that much involved in the business anymore, well, that's more attractive to buyers. The theoretical valuation goes up because of that. So yeah, you're right, less reliance on the owner, strong management team, customer contracts as well. Are your customers tied in? Again, if there are, on a long-term basis, increases the and the whole principle behind that is anyone buying the business, that's revenue guaranteed that they're going to see coming in. So all these little things, they add to the multiple value. So it's all about focus on the multiple if it's an earnings-based valuation. So these are things that business owners should be doing constantly, I would say. If you're doing this, your value of your business is going to go up regardless. So.
That gives both things, like the things you shouldn't do, but also the things you should do is at that end as well. So from a technology point of view, obviously, there's always the buzzword of like AI and all that jazz. But how much does technology and almost the non-tangible items in the business, how do they affect that valuation process?
It's a good point, actually. So in terms of the business itself, where a business is using AI, like I think you've got to be adopting it in most situations now. I think most businesses are, because they see the value of it. So again, I think that will become a norm. You know, I think the bubble of, are you using it for certain situations? I don't necessarily think that's going to increase the valuation too much now, because everybody's doing it.
It's the business status quo.
Yeah, exactly. So, but I do think that valuations from an AI point of view, how we use it internally. So, you know, we can use it. You know, a lot of it's data driven. So especially when we're benchmarking, it just allows us to benchmark and get comparable companies in certain situations using AI tools. So we're testing a few others at the minute. And again, it's all about for us, it's all about either making the process more efficient so that we can, you know, produce valuations that are more affordable and using the technology to do that, and also making them more detailed, more defensible. So it's hand in hand, two things that are going to make it a lot better going forward.
Because the key thing here is that valuation that obviously you're producing in line with these owners, that's what you're going to give to a potential buyer or a potential bank or whatever it is. So the more it's defensible, the less that valuation can be chipped at, isn't it really? You have a stronger case. That number is the number, because we've already fixed the skeletons, we've already fixed the issues. There's nothing to be chipped away at.
I think so, yeah. So you know, it's that story. If you're doing these things 3-4 years ahead of selling or doing something, or whatever the purpose of the valuation is, you're just putting yourself in a stronger position when you get there. And again, more defensible position, because particularly when you're selling a business, and again, the focus is on selling. There's lots of reasons why I do valuation, but that's one of the main ones. You're right. A buyer's going to find an excuse to reduce the price. They want to buy
the best deal as possible.
From an investment point of view. So put yourself out of that position by making it impossible for them to do that, and making it less risky from an investment point of view for them as well. So these are all practical things every business owner should be thinking about. You can't do certain things for certain businesses. So we touched on, like, you know, contract lengths. Not every business can tie down their customers for 3 years. You know, so. But where you can, you should be. That's the point. So.
And it's building that relationship to keep those contracts going as well. But I suppose that's obviously we mentioned this time frame of like 3, 4, 5 years. But the key thing here is you almost need to be thinking about valuation now and get that valuation to see where you're at and realign your expectations. And then you can then build a strategic plan with your accountant to be like, well, I am looking to sell to an EOT in 5 years' time, or sell to the market, or whatever. Even from a tax point of view, inheritance tax point of view, you can be like, well, I'm here now, I want to have a valuation to give to my children in 5 years' time. So it's like the valuation is not just a turn up when someone's offered me to buy it, can I have a valuation please? You need to be thinking valuation now to get the start point, and then a valuation in a couple of years' time to make sure you're on track, and then a valuation for when it's needed. It's not a...
It just sets the right process. I've got a client at the minute that I'm working with where they're looking to do an MBO in 3 years' time. Now but what they don't know now is what it's worth now, to understand what it's worth going forward. So there's a piece there where you're setting the expectation, a right expectation. If it doesn't meet expectations now, well, what can we do to get it to that level? So it just drives action more than anything, I would say, to get to the right level.
And I suppose in that situation as well, valuation here can show the value to that senior team that will be doing the MBO in 3 years' time. So look, it's worth this much. I'm going to want to be out when it's worth this much, but you can then see that in 2-3 years we all grew this by X percent or X million. So assuming we just do the same again when you've got rid of me or when you bought me out, you guys could increase the wealth of what you just bought by X. So you can be using an incentive piece to the people that in an MBO certainly, so a management team buying you out as an owner, they can be incentivized. But well, when I see how this happened, all I have to do is repeat it. Which I know is easier said than done, but it sets again the right mindset of they're buying something worth it that can grow.
It's just all it's doing is setting the right drivers. It's giving them KPIs to hit, valuation KPIs, and that's the important thing. What's going to drive the value of the business up, rather than maybe other KPIs that aren't going to drive necessarily value. So that's what it focuses the mind on, I think.
So then probably on the slightly wilder side of things then, so why are proper valuations probably pricier than people expect?
Yeah, it's often, sometimes people think, oh God, why does it cost that much? Or I've googled it and it comes up with this, or I've used AI and it says this, but there's a lot of work that goes into it. You know, there's more work than people think, there's more experience there again. So I think it's the time that go in. People don't see if they get a report, for example, they don't see the work that necessarily goes into that behind the scenes, all the data analytics that goes into it to work out actually are we in the right ballpark here. So I think it's time more than anything, and also experience as well. Like it's go back to that point where, you know, if you're using an advisor that's done hundreds of valuations, you're paying for that experience as well to get that number right, or as right as it can be. You know, again, any valuation is theoretical. But if you've got advisors that have been there and done it and done lots of valuations, they're more likely to get that valuation in a ballpark that fits.
And that's the key thing as well, it's the experience, it's the work behind it. But you also then have someone that, like yourself, you've done the valuation so you can back it. So if it ever goes to an external source, you've got the experience and that kind of tick box of, look, someone's done this professionally, spent the time, done the work. So you're not just getting, like obviously, like I said, you Google it and it says this, but when they say, can you back up that number, you can't just go, Google said so, because they'll just
it loses credibility.
So it's not just the work itself, it's you.
And ultimately, we're professionals, we've got professional duty there. You know, we don't want a bad reputation for doing valuations that aren't robust. So, you know, that's a massive impact to what we do as well. You know, clients are engaging us to do a proper job. So we're going to spend a proper amount of time on the work to get the number as accurate as we think it can be.
And then is there any key myths about valuations that people need to stop believing, that need to walk in with this belief of...
We've touched on a few, so I'll pick on sort of 4. So, you know, my business is worth whatever anyone says it says it is, or what I say it is. So again, that's that sort of mindset of, well, I'm only going to sell for this. That's fine. But is it? I think it's always good to have a realistic expectation.
Can you back it up?
Yeah, exactly. You need a goal, or shoot for the stars, try and maximise, but also have a realistic valuation there as well, I think. So that's a common sort of myth, if you like. You know, another one is, you know, revenue equals value as well. So I often see that, or, you know, my business is, you know, 5 times revenue and 2 times value. Certain business can be, and you know, SaaS type based businesses can be, for example, IFAs can be, accountancy businesses can be driven by revenue multiples and recurring revenue multiples. it tends to be lower.
Yeah.
I think what often I see is that, oh yeah, my business is 5 times revenue. No, it's probably 5 times EBITDA profit, not 5 times revenue, and there's a big difference between the outputs. So I think, look, you can use it as a sense check and a base point, but I see that a lot where you know, businesses think that the businesses, again, it goes back to that, not understanding what the right methodology for that type of business is. And then probably you know, I put 2 more. I think my mate in the pub sold my business for 20 times. Again, I see that, so you know, hear that so much. But okay, one is your mate's probably lying. You've had a few pints. You know, it probably hasn't sold for 20 times. He sold for 3 or something. And I think as well, it might be a completely different business sector. So just take it with a pinch of salt. Again, it's just, don't rely on what your mates say, you know, come to an advisor that's going to tell you the truth, really. And then the last one, I think, really, again, I think this is a common one, it's getting more common, where maybe business owners had a valuation before and they've maybe used a broker that's said that, oh yeah, we can look to sell your business at 10 times multiple. Again, you've got to be really wary of that, because if it's unrealistic and then you go to market and you don't sell for 10 times, the problem is you still think it's worth 10 times because someone's told you. But I would always say, well, if you haven't sold for 10 times, the market's told you that it's not worth 10 times. So again, bring that expectation to a more realistic level. Whenever you get a valuation done and you're not quite sure, and if it seems too good to be true, get a second opinion, I would say, because if you go in with that mindset and keep that mindset there, you're always going to be disappointed with the output.
And then you're never going to deliver on actually selling the business.
Exactly, exactly.
And then, so probably the final thing really is valuations. How do you think they'll change in the future? Obviously, we mentioned AI briefly, but do you think we can see any huge changes?
I think just tech assisted software's out there. We're already seeing it in the market as well. So again, what that's going to do is drive the accuracy of a lot of the data analytical side and the benchmarking side, which is, again, it's going to hopefully drive efficiency. So be able to do business valuations for a lot more businesses, hopefully. I think that's going to be the main change, but I think the really important thing is you still need that human experience to judge a valuation. So all this AI tech, it's there to assist, not to take over. If you're getting valuations done on a website that's purely AI driven and no one looks at it, that's not a robust valuation. So that's how I see it changing, really.
And I suppose the next steps on the key thing we're probably not mentioning here is that you have the valuation, but then if you were to sell, it's the having someone to hold your hand through that sales process and the due diligence and the back and forwards, the negotiating, the legals. If you've got your valuation from a computer, then you're not going to have that experience to help guide you through a sales process or an EOT process, which is, obviously you've been through this now countless times. You actually can, and obviously most business owners only sell once in a lifetime. You get a few that are serial sellers, but the way it does, so it's a very unique process. That's where your experience again comes in, is the following on from a valuation, the experience of the human.
And you can go back to that valuation and think, oh, actually, right, okay, we added this back, we didn't add this back, or so you won't necessarily get that with a purely AI driven valuation. So I think it's setting the right expectation at the beginning, so that a business owner understands the valuation as well, talking through with them. If you just get a report and you just look at the figure, that's half a job for me. I prefer to try and tell the clients why it's this, why it's that, and explain it to them, because it might be in a report itself, but I think it's better when you hear it from a person that's telling you. So that's it. So I think that's it. So hopefully that's helpful for people that are listening, and thank you for your time.
Cheers.